You sit there, eyes glued to your glowing screens, drowning in a deluge of red and green numbers, believing that if you just stare hard enough, the market will reveal its secrets to you. But let me tell you something you desperately need to hear. You are looking for gold in a sewer. The modern financial landscape is a carnival of folly, a lollapalooza of stupidity designed to separate the impatient from their capital, and you are walking right into the woodchipper with a smile on your face because some 20-year-old on the internet told you that diversification is the holy grail of wealth. It is asinine. You have been fed a diet of intellectual sludge regarding asset classes, convinced that you must own a little bit of everything. Some crypto, some bonds, some international equities, perhaps a little real estate crowdfunding, to be a sophisticated investor. But that is not sophistication. That is merely protection against your own ignorance, as I said at the Berkshire AGM in 2004. If you actually knew what you were doing, you wouldn't need to spray your money across the landscape like a feral cat marking territory. You would find the one or two things that actually make sense, load the truck, and then sit on your hands for a decade. But you can't do that, can you? You lack the temperament. You have the attention span of a gnat and the discipline of a drunkard in a distillery. I am not your advisor. If I were, I would tell you to consider taking a sledgehammer to your current portfolio theory and starting from a place of total subtraction. You want to understand asset classes. First, you must understand what is garbage. You look at the history of wealth, real wealth, not this flash in the pan paper gain nonsense that evaporates the moment the Federal Reserve tightens the spigot. Look at John D. Rockefeller. Look at Andrew Carnegie. Look at the early days of Berkshire Hathaway. Did Rockefeller have a balanced portfolio of $60.40 stocks and bonds with a 5% allocation to speculative tulip bulbs? No. He owned oil. He understood oil. He squeezed every ounce of efficiency out of that industry until he dominated the earth. He didn't hedge his bets with a side hustle in textile mills he didn't understand. The great fortunes of the world were built on concentration, on finding a bonanza and riding it until the wheels fell off. Yet you are terrified of concentration because you are terrified of doing the work required to understand a single asset class deeply. You prefer the illusion of safety provided by mediocrity. You buy the index, you buy the bond fund, you buy the gold ETF, and you ensure that your returns will be perfectly average minus the fees you pay to the helpers who are laughing at you. This is the institutional imperative we talked about in the 1989 shareholder letter, mindless imitation of peers. It is a recipe for a life of financial quiet desperation. Let us talk about the mental model you are failing to use, the one tool that could actually save you from your own stupidity: inversion. Algebra requires you to invert equations to solve them, and life is no different. As the great mathematician Carl Jacobi said, invert, always invert. You are asking, which asset class will make me rich? That is the wrong question. It is a stupid question because it assumes there is a positive answer waiting for you. The right question, the inverted question, is which asset classes will destroy me? Which assets are rat poison? Which assets are guaranteed to lose purchasing power over time? If you figure out what kills you and avoid it, you will survive. And in this game, survival is the only thing that matters. If you avoid the zeros, the math takes care of itself. But you don't do this. You chase yield. You chase heat. You see your neighbor getting rich on some digital token that produces nothing, has no cash flow, and exists only as a blip on a server. And you succumb to the most dangerous force in finance, envy. Envy is the only one of the 7 deadly sins that isn't even fun. Gluttony is fun. Lust is fun. Envy is just miserable. And yet it drives your asset allocation more than logic ever will. You buy things you don't understand because you can't stand the thought of someone else making money faster than you. That is not investing. That is a psychological defect. I learned this lesson the hard way, And because I am generous enough to share my scars, I will tell you about a mistake I made so you can see that even a genius can be an idiot if he forgets to invert. It was 1962. I was young, arrogant, and I thought I could analyze anything. I put 100,000, which was a fortune back then, equivalent to nearly $1 million today, into a business that made electrical transformers. I looked at the projections. The projections were beautiful. Up and to the right. A bonanza. But I didn't invert. I didn't ask, what happens if the technology shifts? What happens if the management is incompetent? I focused on the upside. Well, the technology didn't just shift, it evaporated. The management was worse than incompetent, they were delusional. I lost the entire 100,000. It went to zero. I wiped out years of savings because I bought a story instead of a balance sheet, and I failed to consider the durability of the asset. I bought a declining asset class thinking it was a growth engine. That loss burned a hole in my psyche that has never fully healed, and it taught me that the return of your capital is far more important than the return on your capital. You must view every asset class through the lens of that 100,000 loss. Assume it will go to zero. Now, prove to me why it won't. If you can't do that, you have no business owning it. So, let us apply this inversion to the asset classes you are so eager to hoard. Start with the safe haven gold. People love gold. They think it preserves wealth. But what is it? It is a non-productive asset. It sits there. It looks at you. You can fondle it, I suppose, if you are into that sort of thing, but it will never produce a dividend. It will never grow earnings. It will never innovate. If you own an ounce of gold today, in 100 years, you will still have an ounce of gold, and you will have missed out on a century of human ingenuity and productivity. As I said at the 2011 USC event, I would take the productive land or the ownership of a great business over a shiny metal any day of the week. Buying gold is betting on fear. It is betting that the world is going to hell. And while the world is often foolish, betting against human progress has historically been a terrible wager. Yet, you hoard it because you are scared of inflation. You know what beats inflation? Pricing power. A business that can raise prices without losing customers. That is an asset. A metal rock in a vault is a pet rock for adults. Then we have the modern darling, the digital gold. The cryptocurrencies. I have called it rat poison squared, and I was being polite. This is the ultimate violation of the inversion principle. You are buying something that produces nothing, hoping to sell it to someone even more foolish than you for a higher price. It is the greater fool theory in its purest, most toxic form. It is a venereal disease of the financial system. When you buy a farm, you look at the crop yield. When you buy an apartment building, you look at the rent roll. When you buy a crypto token, you look at a chart and pray. That is not an asset class. That is a casino where the house takes a cut and the lights are rigged to induce seizures. You are trading turds, and you think you are a sanitation engineer. Avoid it. Invert the desire to be cool and modern. Be old. Be boring. Be rich. The desire to participate in this mania is driven by the fear of missing out, but you should be far more afraid of participating in a mass delusion. And what of bonds? The traditional ballast of a portfolio. For years, I have said that bonds are return-free risk in an inflationary environment. If you lend money to the government at 3% and inflation is running at 5%, you are slowly bleeding to death. You are locking in a guaranteed loss of purchasing power. Why would a rational person do that? Because a textbook told them to. Because 6 out of 40 is the standard doctrine. Standard doctrine is usually wrong because it is written by academics who have never run a business. Invert the bond. Why would you lend money to a debased currency issuer for a pittance? Unless you are parking cash for a very short term, bonds in a high inflation era are a trap. They are not an asset. They are a wasting disease. You must look at assets that can reprice themselves. Real estate equities with pricing power. These can fight inflation. A fixed coupon cannot. It is static. It is dead. And yet, trillions of dollars sit in these instruments because fund managers are more interested in job security than in making you rich. This brings us to the only way you should ever filter an asset class. You must ruthlessly categorize every opportunity into one of three buckets. If you cannot do this, you are lost. The three decisions one, yes. So this is a rare, screaming bargain where the odds are heavily in your favor. Two, and oh, this is 99% of everything, overvalued, fraudulent, or mediocre. Three, 2OHRD. This is where you put everything you do not understand perfectly. Most of you are playing in the too hard pile and pretending it is a yes. You buy biotech stocks you don't understand. You buy foreign currencies you can't analyze. You buy complex derivatives because a broker sold you on the yield. This is madness. You have a circle of competence. It is likely very small. That is not a shame, it is a reality. My circle is small. Warren's circle is small, but we stay inside it. When you step outside that circle to buy an asset class you heard was good, you are practically begging the market to slaughter you. You must invert your confidence. Assume you are the patsy at the poker table. If you don't know who the patsy is within 10 minutes, it's you. In the realm of asset classes, if you cannot explain how the cash flow is generated, how the moat is defended, and how the valuation is justified on the back of a napkin, it goes in the too hard pile. Do not touch it. Do not look at it. Let others get rich or go broke on it. You stay where the math works. You see, the problem with the who 5 asset classes educational model is that it treats them as equal citizens in a democracy. They are not. Some are aristocrats, and some are peasants, and some are criminals. Equities, ownership of productive businesses, are the aristocrats, provided you buy them at a sensible price. They work for you while you sleep. They employ people. They create value. Everything else is a derivative of that productivity or a hedge against it. Real estate is a cousin to equities. It is a business of rent, commodities, currencies, collectibles. These are speculations. They are not investments. An investment, by Graham's definition, which we adhered to at Wesco and at Berkshire for decades, promises safety of principal and a satisfactory return based on thorough analysis. Speculation promises excitement and a chance at a windfall. If you are mixing the two and calling it a portfolio, you are mixing fine wine with sewage and hoping for a decent cocktail. So, before we even begin to analyze the history of these classes in the next section, you must purge your mind of the idea that you need them all. You do not. You need to avoid the ones that will kill you. You need to avoid the ones that require you to be smarter than you are. You need to avoid the ones that are popular with the cocktail party crowd. You need to sit on your ass and wait for the fat pitch. And when that pitch comes, when a productive asset class is hated, cheap, and ignored, that is when you swing. Until then, keep your bat on your shoulder and stop swinging at every piece of garbage the market throws at you. The market exists to serve you, not to instruct you, and certainly not to entertain you. If you are entertained, you are doing it wrong. You are running out of time, and you don't even realize it because you are too busy looking at ticker symbols that don't matter. You treat time as if it is an infinite resource, squandering it on analysis paralysis and the consumption of financial pornography. Let me be brutally clear, time is the most ruthlessly decaying asset you own. Every second you spend analyzing a mediocre opportunity is a second you have stolen from finding a great one, and unlike capital, you cannot earn more time. Once it is spent, it is gone forever. The mathematics of your remaining years are grim, and if you are wasting your compounding runway on assets that yield sub-par returns, you are committing financial suicide by 1,000 cuts. Compounding is the eighth wonder of the world, as Einstein reportedly said, but it requires a long runway to take off, and every time you reset the clock by chasing a new fad or selling a great asset to buy a mediocre one, you are clipping the wings of that exponential curve. You need to understand that investing is not about activity, it is about the allocation of a finite resource, your life, into vehicles that will carry you forward without requiring you to push them. If you are constantly pushing, you are not investing, you are laboring, and labor is a terrible way to get rich. The fundamental algorithm of life and investing is opportunity cost, and it is the most powerful mental model in the world. Yet most of you ignore it because it requires you to be honest about your own limitations. Opportunity cost is simply this: the value of the best alternative you forego when you make a choice. If you have a brilliant idea that will return 15% with high certainty, and you put money into a diversified bond fund yielding 4%, you are not making 4%, you are losing 11%. You are destroying value. You must measure every single asset class against your best idea, not against cash. Cash is trash, as they say, but it is the default position. If you cannot find an investment that beats your best existing idea, you do nothing. You sit. You wait. This is the hardest thing for a human being to do because we are wired to act, to hunt, to gather, to do something when we feel anxious. But in finance, activity is the enemy of returns. The big money is not in the buying and selling, but in the waiting. You need the patience of a saint and the decisiveness of a viper. When you find that one thing, that one asset class or specific equity that screams value, you strike, and you strike hard. Until then, you are merely a spectator, and you should be happy to be one. I am not your advisor, but if I were, I would tell you to consider the fat pitch philosophy of Ted Williams. In his book, The Science of Hitting, Williams divided the strike zone into 77 cells, each the size of a baseball. He knew that if he swung at balls in his happy zone, he would bat 400. If he swung at balls on the corners, even if they were strikes, his average would drop to 230. Investing is the same, except for one massive advantage: there are no called strikes. The market can throw you General Motors at 40, and you can stand there with your bat on your shoulder and do nothing, and the umpire will not call you out. You can wait for a year. You can wait for 5 years. You can wait until the market panics and throws you General Motors at 20 EV, right in your wheelhouse. And then you swing with everything you have. But you don't do that. You swing at everything. You swing at crypto because your neighbor did. You swing at NFTs. You swing at overpriced tech stocks. You are batting 230 because you lack the discipline to wait for the fat pitch. You are letting the pitcher, the market, dictate your actions rather than dictating your own terms. This is folly. It is a Lollapalooza of incompetence. Let me tell you about a mistake I made, a mistake of omission that cost me a fortune. To illustrate the pain of opportunity cost, the year was 1977. I was looking at a company called Belridge Oil. It was a California oil producer, sitting on a massive reserve of heavy crude. The stock was trading around $115 per share. Now, I knew the value was there, understood the assets. I understood the reserves. It was not a complicated business. They pumped oil out of the ground. It was undervalued by any rational metric. I bought 300 shares. That was the mistake. I had the capital to buy thousands of shares. I had the liquidity. I had the knowledge. But I was trying to be too cute, trying to buy it a little cheaper, or perhaps I was just being lethargic. I was sucking my thumb. I didn't load the truck. 2 years later, in 1979, Shell Oil came along and bought Belridge Oil. Do you know what they paid? They paid roughly 3 to 6.65 per share. My 300 shares turned into a nice little profit, yes. But if I had bought the 3,000 shares, I could have easily afforded, and should have bought based on the sheer obviousness of the value. I would have made millions more. That mistake didn't show up on a balance sheet. It didn't look like a loss in my tax returns. But it was a massive loss of opportunity. I left a fortune on the table because I failed to seize the fat pitch when it was staring me in the face. That is the kind of mistake that haunts you. Losing money on a bad trade hurts, but missing a life-changing bonanza because you were too timid or too cheap is a special kind of hell. It taught me that when the odds are heavily in your favor, you must bet big. You cannot dip your toe in. You must jump in with both feet. This brings us back to the asset classes you are studying. You are likely spreading your money across 5 or 6 different buckets. Stocks, bonds, real estate, commodities, cash, thinking you are managing risk. You are not managing risk, you are ensuring mediocrity. If you analyze these classes and determine that, say, real estate offers the best risk-adjusted return for the next decade because of a supply shortage and inflationary pressures, then why in God's name would you put 20% of your money into bonds which are guaranteed to lose purchasing power? You are diluting your best idea with your fourth best idea. That is insanity. It is like marrying your fourth favorite suitor because you want to diversify your romantic risk. The algebra of opportunity demands that you concentrate your capital in the highest conviction assets you can find. If you don't know what you're doing, sure, buy the index and go play golf. That is a perfectly respectable strategy for the know-nothing investor. And I mean that with no disrespect. Knowing you know nothing is a form of wisdom. But if you claim to be an active investor, if you claim to be studying these asset classes to gain an edge, then diversification is a confession of ignorance. You are admitting you don't know which one will win, so you bet on all of them. You must view every asset class through the lens of time. Equities, historically, are the only asset class that consistently captures human ingenuity and productivity over long periods. When you own a stock, you own a piece of a machine that is constantly trying to improve itself, cut costs, and launch new products. It is a living, breathing organism of value creation. Commodities are dead. A barrel of oil is a barrel of oil. It does not innovate. It does not pay a dividend. It costs money to store. It is a speculation on price, not an investment in productivity. Real estate is somewhere in the middle. It produces yield, but it requires maintenance and taxes. Bonds are contracts denominated in currency that politicians are actively debasing. When you understand this hierarchy, you stop viewing them as equals. You realize that asset allocation is often just a fancy term for hiding from the truth. The truth is that most asset classes are garbage most of the time. The fat pitch in bonds might happen once every 20 years when yields spike to ridiculous levels. The fat pitch in real estate might happen after a crash. The rest of the time you should be doing nothing. You should be sitting on your hands, reading, learning, and waiting. But you are addicted to the action. You check your phone every 5 minutes. You trade in and out. You are paying taxes, you are paying spreads, and you are paying with your attention. The modern financial industry is built to exploit this weakness. They created ETFs for everything. You can buy an ETF for water, for timber, for uranium, for video games. They have gamified the destruction of your wealth. They want you to think that you need exposure to everything. You do not. You need exposure to value. If value is in a small cap industrial stock, you buy that. If value is in a farm in Nebraska, you buy that. If value is nowhere to be found, you hold cash and you wait. The ability to do nothing is the ultimate superpower. It is the only way to exploit the manic, depressive nature of the market. The market is there to serve you, not to instruct you. Think about the Bellridge mistake again. A 115 to 3,665 in 2 years. That is a roughly 30 bagger. One decision like that sets you up for life. You don't need 50 decisions. You don't need a balanced portfolio of 50 mediocre decisions. You need 3 or 4 great ones in a lifetime. That is it. The rest of the time, you are just trying not to be stupid. You are trying to avoid the zeros. You are trying to keep your powder dry. But you are out there swinging at bad pitches, eroding your capital, and wasting your time. Stop it. Invert your behavior. Instead of asking, what should I buy today? Ask, why should I buy anything today? The burden of proof should be on the activity, not the inactivity. Default to zero. Default to doing nothing. Only move when the evidence is so overwhelming that it would be pathetic to stay still. That is how the great fortunes were built, not by day trading, not by diversification, but by aggressive patience. You are surrounded by mimics, by actors who have memorized the lines, but do not understand the play. And if you listen to them, you will be led into the slaughterhouse. In the world of asset classes, there is a distinct and dangerous difference between true knowledge and what I call Shaffer knowledge. I told this story at USC in 1994, and it bears repeating because it is the single best filter for ignoring the noise that is currently rotting your brain. The story goes that after Max Planck won the Nobel Prize, he went around Germany giving the same lecture on quantum mechanics. Over time, his chauffeur memorized the lecture and said, "Professor Planck, it must be boring giving the same speech. How about I give it in Munich, and you sit in the front row wearing my chauffeur's cap?" Planck agreed. The chauffeur delivered the lecture perfectly. Then, a physics professor stood up and asked a devastatingly complex question. The chauffeur replied, "I am surprised to find such an elementary question in an advanced city like Munich. I will let my chauffeur answer it. The world is full of chauffeurs. The people you see on television, the experts, on social media, the talking heads on financial news networks. They are chauffeurs. They have good voices. They have good hair. They know the jargon. They can say moving averages and Fibonacci retracement and quantitative easing with great conviction. But they do not know anything. They are mimicking the sounds of knowledge without possessing the substance of it. They cannot answer the hard questions. They have never actually allocated capital in a way that put their own survival at risk. They are paid to talk, not to be right. You must understand the incentives here. The financial news network does not exist to make you rich. It exists to sell your eyeballs to advertisers. To do that, they need action. They need noise. They need to tell you that markets are in turmoil, or that this is the next big thing. If they told you the truth, which is that you should buy a boring index fund or a high-quality business and then go read a book for 10 years, they would go out of business. You must tune them out. You must treat their advice as noise, as static, as the chattering of monkeys in the trees. If you base your asset allocation on the advice of a man who needs to fill a 20-minute segment every day, you deserve the losses you are about to suffer. This brings us to the most critical concept in wealth preservation, the circle of competence. You do not need to be an expert on every asset class. You do not need to understand the intricacies of the bond market, the supply chains of the semiconductor industry, and the zoning laws of commercial real estate all at once. You only need to understand one thing very well. If you have a circle of competence that only includes local car washes, and you stick to buying local car washes at good prices, you will run circles around the genius who is trying to trade crypto, biotech, and foreign exchange simultaneously. The size of the circle does not matter. Knowing its boundaries is vital. Inside the circle, you are safe. Outside the circle, you are gambling against sharks. The modern investor, fueled by the Dunning-Kruger effect and a little bit of easy money, thinks their circle is the entire world. They read a Wikipedia article on lithium mining and suddenly think they are geologists. This is arrogance. It is hubris. And the market punishes hubris with a severity that is almost biblical. You must have the humility to say, "I don't know." If you are looking at an asset class and you cannot predict with a high degree of certainty what it will look like in 10 years, put it in the too hard pile. Do not feel bad about it. Confucius said that real knowledge is to know the extent of one's ignorance. Be ignorant of 99% of the market so you can be the master of the 1% that matters. To survive this game, you must adopt a code of conduct that is rigid, unyielding, and totally contrary to the culture of instant gratification that surrounds you. You must ruthlessly execute the 3 decisions that govern all rational life. You must live below your means to secure your freedom, because a man with debt is a slave to his own stupidity. You must never interrupt compounding unnecessarily, which is the cardinal sin of finance, and the equivalent of stomping on a seedling you just planted. And you must remove toxic and unreliable people from your life immediately because you cannot make a good deal with a bad person. This last point is often ignored in financial discussions, but it is paramount. If you associate with people who are impulsive, irrational, or dishonest, their chaotic nature will bleed into your financial life. They will drag you into bad investments. They will panic when the market drops. They will convince you to lend them money that you will never see again. Reliability is the rarest quality in the world. If you find a reliable person, hold on to them. If you find a reliable asset, hold on to it. Everything else is just noise and potential disaster. You see, the entire educational model of 5 of asset classes is flawed if it implies you should act on all of them. It is useful only as a map of the battlefield, so you know where the landmines are. You study history not to predict the future, to understand the nature of the beast. You study the Weimar Republic to understand what printing money does to bonds. You study the 1929 crash to understand what leverage does to stocks. You study the Dutch tulip bulb mania to understand what crowd psychology does to collectibles. You are building a latticework of mental models, as I have preached for decades. You hang your experience on this latticework. If you just memorize facts, stocks return 7% on average. You will fail when the facts change. But if you understand the ES models, supply and demand, margin of safety, opportunity cost, inversion, you can navigate any environment. You become adaptable. You become rational. And in a world of raving madmen, the rational man is king. Now, let us address the elephant in the room. You are likely sitting there thinking, but Charlie, this is all very philosophical, but I want to make money of now. That is your problem. The desire to get rich fast is the most dangerous emotion you possess. It is the reason you buy lottery tickets. It is the reason you leverage your house to buy a hot stock. It is the reason you are easy prey for the charlatans. Wealth is the byproduct of good decisions made over a long period of time. It is not a destination you sprint to. It is a residue of a life lived rationally. If you can suppress your envy, control your ego, and operate within your circle of competence, the money will come. It has to. It is a mathematical certainty. But if you try to force it, if you try to outsmart the system will crush you. The market is a mechanism for transferring wealth from the impatient to the patient. Which one are you? Retired teacher 47. I saw your comment on the last video. You said, "This sounds great, but waiting is the hardest part. It feels like I'm doing nothing while everyone else is making money, and I feel like a fool for sitting in cash." You are right that it is hard, but you are wrong about being a fool. You are suffering from social proof bias. You look at the herd running off the cliff, and you feel an urge to join them, because running feels like progress. It is not. The hardest work in investing is not the buying or the selling. It is the emotional discipline required to do nothing when doing nothing is the right thing to do. You are not sitting in cash. You are deploying strategic patience. You are a sniper waiting for the target. The idiots are the ones running into the open field, firing their guns into the air. Let them run. Let them exhaust their ammunition. When the dust settles, you will be the one with the capital, and they will be the ones with the stories of how they almost made it. Do not envy the fool who wins the lottery. His success is not replicable, and it will likely destroy him. Envy the man who gets rich slowly, for he has built a foundation that can withstand the storm. We have covered the folly of diversification for its own sake. We have covered the necessity of inversion, looking at what kills you before looking at what thrills you. We have covered the decay of time and the brutal algebra of opportunity cost. We have covered the difference between true knowledge and Chauffeur knowledge. Now, the time for listening is over. The time for action, or rather, the action of subtraction, is here. You are likely holding something in your portfolio right now that you do not understand. You bought it because a friend told you to, or because you saw it on TV, or because the chart looked pretty. It is a weed in your garden. It is consuming your capital and your mental energy. It is a violation of everything we have discussed. I am not your advisor, but if I were, I would tell you that you cannot build a skyscraper on a foundation of mud. You must clear the debris. You must prune the dead wood. You must have the courage to admit you made a mistake, take the loss if necessary, and reallocate that capital to your highest conviction idea, or to cash if you have no high conviction ideas. Cash is an option on the future. Bad investment is a liability on your future. So, here is your task. I do not want you to just nod your head and click to the next video. I want you to act. I want you to demonstrate that you have the temperament to be a rational allocator of capital. Open your brokerage app right now. Find one position that you do not understand, one position that you bought out of envy, or one position that violates the principles of safety and value. Sell it. Sell the whole thing. Take the cash. Clear your mind. Then come back here and comment down below. I will reply to the first 50 of you who have the guts to cut the cancer out of your portfolio. Do it. Prove to yourself that you are not a chauffier. Prove that you are the owner of your financial destiny. The market does not care about your feelings, and neither do I. I care about your rationality. Now get to work.